Russia is having trouble getting payments for its oil products from foreign banks in China, Turkey, and the United Arab Emirates. Reuters, citing unnamed industry-related sources, reports that the banks have tightened their sanctions compliance requirements in recent weeks. This has led to delays in some places and denials of money transfers for the Kremlin. The agency attributes this to the U.S. Treasury's decree from December 2023, which suggests sanctions for evading the Russian price cap.
In the end of February, UAE banks had to raise payments scrutiny as they were asked to provide data to the US correspondent banks and the US Treasury if they have transactions that go to China on behalf of a Russian entity, according to the banking source familiar with the matter, from the publication in Reuters.
Jeffrey Stonfield and Stephen Tyne, professors at Yale University, who at the beginning of the invasion launched a campaign to make foreign companies leave Russia, have came up with the way to make the sanctions work to their full potential. They proposed 3 steps. The first is to strengthen restrictions on raw material exports. According to them, Russia's entire export industries are virtually unaffected by the sanctions. Russia has a stronger need to export its materials than the world needs to buy them. The second is tougher enforcement of existing sanctions. Professors assure us that through widespread smuggling and so-called parallel import schemes, Putin has so far managed to evade Western sanctions. And the third is confiscation of Russian assets.
Hundreds of leading business, financial and government voices offering their public support and reassurance that such a move would hardly undermine the dollar, especially given there is no functional alternative reserve currency ready to replace the dollar. It's impossible to see how Ukraine would possibly fund its massive reconstruction burden without a reparation payment, with the costs and risks prohibitive to both the private sector and the Western governments, from the publication in Fortune.
Analysts agree with the view of the Yale professors. In their opinion, the world is still living in the illusion of Washington consensus formed in the late 1980s, according to which touching private or state property is prohibited because it undermines the existing economic model. Experts argue that the current situation in the global economy forces us to reconsider old concepts. They are sure that if Russia is recognized as a country that has committed a crime against the world order, there should be no legal issues with the confiscation of Russian assets.
The best answer I may have heard on the matter of this 300 billion is an article by Nobel laureate in economics Joseph Sirius, which appeared in early 2024. He writes that when these assets were frozen, trust was not undermined. Moreover, when they fear that confidence will be undermined, he asks in his article, well, where will this money be transferred to? I mean, there's Saudi Arabia, other countries that keep money in the US and in Europe. Where will they transfer it to? And in his article, he states that there is simply nowhere.
However, the already existing sanctions force the Kremlin to support its own enterprises at the expense of the federal budget. The state-owned company Alrosa controls 95% of Russia's and more than a quarter of the world's diamond production. To support the company, Kremlin will start buying its products for the first time in 15 years with budget money. The newspaper reported that due to Western sanctions, Alrosa's stock of unsold diamonds jumped more than 1.5 times last year, and the company lost 15% of its profit and 9% of its revenue at the end of the year. Reported by Anastasia Tarnavska, Andriy Dmitrenko, UATV News.